A stock exchange is a place where, or an organization through which, individuals and organizations can trade stocks. Many large companies have their stock listed on a stock exchange. This makes the stock more liquid and thus more attractive to many investors. It may also act as a guarantor of settlement. Other stocks may be traded over the counter, that is, through a dealer. Some large companies will have their stock listed on more than one exchange in different countries, so as to attract international investors. Stock exchanges may also cover other types of securities, such as fixed interest securities, bonds, or less frequently derivatives, which are more. Trade in stock markets means the transfer for money of a stock or security from a seller to a buyer. This requires these two parties to agree on a price. Equities, stocks, or shares confer an ownership interest in a particular company. Participants in the stock market range from small individual stock investors to larger trader investors, who can be based anywhere in the world, and may include banks, insurance companies, pension funds, and hedge funds. Their buy or sell orders may be executed on their behalf by a stock exchange trader. Some exchanges are physical locations, where transactions are carried out on a trading floor, by a method known as open outcry. This method is used in some stock exchanges and commodity exchanges, and involves traders shouting bid and offer prices. The other type of stock exchange has a network of computers, where trades are made electronically. An example of such an exchange is the Nasdaq. A potential buyer bids a specific price for a stock, and a potential seller asks a specific price for the same stock. Buying or selling at the market means you will accept any ask price or bid price for the stock. When the bid and ask prices match, a sale takes place on a first-come, first-served basis if there are multiple bidders or askers at a given price. The purpose of a stock exchange is to facilitate the exchange of securities between buyers and sellers, thus providing a marketplace. The exchanges provide real-time trading information on the listed securities, facilitating price discovery. The New York Stock Exchange (NYSE) is a physical exchange, with a hybrid market for placing orders electronically from any location, as well as on the trading floor. Orders executed on the trading floor enter, by way of exchange members, and flow down to a floor broker, who submits the order electronically to the floor trading post for the designated market maker (DMM) for that stock to trade the order. The DMM's job is to maintain a two-sided market, making orders to buy and sell the security when there are no other buyers or sellers. If a spread exists, no trade immediately takes place. In this case, the DMM may use their own resources, money or stock, to close the difference. Once a trade has been made, the details are reported on the tape and sent back to the brokerage firm, which then notifies the investor who placed the order. Computers play an important role, especially for program trading. The Nasdaq is a virtual exchange, where all of the trading is done over a computer network. The process is similar to the New York Stock Exchange. One or more Nasdaq market makers will always provide a bid and ask price at which they will always purchase or sell their stock. The Paris Bourse, now part of Euronext, is an order-driven, electronic stock exchange. It was automated in the late 1980s floor of the Palais Brongniart. In 1986, the CATS trading system was introduced, and the order matching process was fully automated. People trading stock will prefer to trade on the most popular exchange, since this gives the largest number of potential counterparties, buyers for a seller, sellers for a buyer, and probably the best price. However, there